Loans for properties are common in businesses, whether it's for your office, warehouse, or storage. A common mistake is for a loan payment to be lumped in one place, paying down the loan. And when that happens, your books can look clean while your numbers are actually wrong. In this video, I'll show you how to record loan payments correctly in QuickBooks Online so your loan balance, expenses, and escrow all stay accurate. Principal is a payment used to reduce the loan balance. Interest is the cost of borrowing money from the lender. Escrow is a special savings account used to pay taxes and insurance. Each of these needs to be tracked separately in QuickBooks to keep your financial reports accurate. We're going to set these accounts up once, and then monthly payments becomes easy. First, we need to add the office spaces that were purchased using the loan. So we're going to click on New Account, and the account name will be Office Spaces. The account type will be Fixed Assets, and the detailed type will be Buildings. We're going to leave Original Cost blank for now, and then we'll save. Next, we'll add the loan that we used to purchase the office spaces. The account name will be First Time Funding Loan. The account type will be Long-Term Liabilities, and the detail type will be Notes Payable. We'll leave the Unpaid Balance section blank. That will be added later. And then we'll save. The next account will be called Interest Expense. The account type will be Expenses, and the detail type will be Interest Paid, and then we'll save. The last account will be called Escrow Account. The account type will be Other Current Assets, and the detail type will be Prepaid Expenses. This will be used to pay property taxes and insurance when they come due, and then we'll save. This is one of the few times a journal entry is the right tool. We're going to use it to add the loan that was used to purchase the office spaces. We'll click on Create and then Journal Entry, and this will be dated the same day as the purchase, which was October 16th. Our first account will be First Time Funding Loan, and we're going to credit the liability account $315,265, and we're going to connect it with the vendor, First Time Funding, and the other account will be Office Spaces, which is what was purchased using the loan, and we're debiting that account by the same amount, and then we'll save. The first loan payment was made on November 16th. We're going to use the mortgage statement from November 5th to know how to split the total payment of $2,423.89. The mortgage statement shows that $495.89 goes to the principal on the loan, $1,235 goes to interest, and $693 goes to escrow. We'll add the first loan payment that was made in November. This will be recorded as an expense with 3 lines, one for each category. We'll click on Create and then Expense. And our payee will be First Time Funding. The payment account was Chase Checking, and the payment date was November 16th. Our first category will be First Time Funding Loan, and this was for $495.89. This pays the loan principal. Then we'll use the Interest Expense account, and this is for $1,235. And then we'll add our final category, which is the escrow account for $693. So this totals our monthly payment of $2,423.89. Then we'll save and close. It's important to check that your new loan balance and escrow balance matches with the following month's loan statement. This is how you catch mistakes before they compound month after month. The loan balance is showing $314,769.11. The loan balance in the register shows the same amount after the November payment was made, so that looks good. Now let's check the escrow account. We can see that the escrow balance on the loan statement matches what is in the register. This is an important step to take on a monthly basis to ensure that your split payments are recorded correctly. The lender is responsible for pulling money from your escrow account to pay property taxes and insurance. In order to record those business expenses, we need to create 2 additional accounts. The first account that we'll create is called Property Taxes, and this will be an expenses account. The detail type will be Taxes Paid, and then we'll save anew. And the second account will be called property insurance. This will also be an expenses account, and the detail type will be insurance. And then we'll save and close. Let's say that funds were pulled from your escrow account on December 12th so that the lender can pay your property insurance. We'll record this as a journal entry, which will be dated December 12th. The funds will be pulled from the escrow account. So we are going to credit the asset account by $450 to decrease it, and we're going to associate this with first-time funding. And the expense account is property insurance. Even though the lender pays this for you, it is still considered a business expense. So we're debiting the expense account to increase it by $450. We'll add the vendor name, which is Liberty Mutual, and then save and close. Even though the breakdown of a mortgage payment can change from month to month, you don't need to start from scratch every time. A recurring transaction can act as a flexible template. From the gear icon, we'll click on Recurring Transactions and then New, and the transaction type will be Expense, and then we'll click OK. The template name we'll call First Time Funding Loan, and the type will be Unscheduled, which will allow us to make changes to it before recording it. That's important because loan amounts change slightly each month. The payee will be First Time Funding, and the payment account will be Chase Checking. Now we'll add our 3 categories for how the loan payment is split. These categories are the same 3 accounts we used earlier for principal, interest, and escrow. For the principal portion, we'll use First Time Funding Loan. We'll use the figures from the November statement, so this will be $495.89. Next we have the interest expense account, and the amount is $1,235, and our escrow account for $693, and then we'll save the template. For our December 16th payment, we'll use the template, so we'll click on Use. And we just need to adjust the date and the amounts. This keeps your process consistent while still matching each month's loan statement exactly. So we'll change the payment date to December 16th. First time funding loan will need to be changed to $502.74, so that matches the principal payment. And the interest expense will be changed to $1,228.15. There is no change to the escrow account, and then we'll save and close. Knowing how to split loan payments ensures that you keep all of your accounts accurate. Otherwise, you run the risk of recording the entire payment to the loan balance, which can make it look like you owe thousands less than you actually do. Splitting loan payments correctly keeps your balance sheet accurate and ensures you don't miss legitimate business deductions. If you want more tutorials like this, subscribe to the channel, and for vehicle and equipment loans, you'll find a separate video linked above.